Good morning and welcome to Charting the Markets on Wednesday, the 13th of September. Asian indices declined overnight, taking their cue from a weaker finish on Wall Street, where tech stocks fell back following disappointment around the Apple product event and pre-US inflation nervousness. And that inflation data is out at 1:30 p.m. today. That is US CPI for August. We expect it to rise by 0.3% month on month, up from 0.2% in July, and on a year-to-year basis by 3.4%. We expect it to rise compared to 3.2% in July. Investors will also look at core CPI, and that we expect to rise by 0.2% month on month, in line with last month, and by 4.5%, I should say, year on year, down from 4.7%. And when we look at the European session, we can see here that the FTSE 100 has actually declined overnight on that weaker US and Asian session, and so far has held above the orange line here, the 55-day simply moving average at 7,476, and basically, we're just range trading ahead of that inflation print out of the US later on today. But what we also saw in the UK earlier this morning was that UK GDP dropped by 0.5% month on month in July. That was the quickest pace in 7 months, and it was versus an expected 0.2% decline. So wet weather and NHS, as well as rail strikes in the United Kingdom, had a really negative effect on GDP, and year on year GDP growth dropped to 0%. Versus a forecast of 0.4%. Now, if you look at the FTSE, basically we are sort of trading sideways at the moment. We've got really good resistance between the early September highs between 7,524 and 7,551. And basically, provided we stay below there, we should continue to range trade here, and could perhaps retest the breached previous resistance line, which currently comes in around 7,467. Also, from a technical perspective, nothing really has changed. We are still in an uptrend, provided we stay above 7,369. If we move on to the European session, what we can see here is that the DAX 40 contract has declined for the second straight day in a row at the moment, and it did so as the European Central Bank, some of its sources there basically suggested last night that inflation forecast would remain above 3% in 2024, strengthening the view that interest rate hike, that a hike may actually be seen at tomorrow's meeting, and that has led to the DAX 40 coming off, and we can see here that we have come close to last week's low at 15,575, and the red line here, the 200-day simple moving average at 15,528. So this is the key support area to watch out for ahead of the August low at 15,469. From a technical perspective, provided we stay below Monday's high on a daily chart closing basis, and that was made at 15,871, further downside does look more likely than any upside reversal. And the story is quite similar with regards to the S&P 500, as we can see here. We are also coming off. We had a negative session yesterday on that not so successful US Apple product launch, and as tech stocks actually slid slightly. And we can see here that the S&P 500 is currently trading around 4,450, just above that, 4,458, ahead of this US CPI print out later on today at 1:30 p.m. UK time. Now, if the inflation rate were to fall unexpectedly, we could have a rally back up again to the 55-day simply moving average here in orange at 4,479, and also above Monday's high at 4,491. And that would need to be exceeded for us to resume our ascent again towards the September high at 4,540. But as long as we stay below Monday's high at 4,491, further downside may actually be in store for the S&P 500 as well. The US dollar, which last week ended its 8th consecutive week of gains, continues to rise, and we can see that against a lot of currencies. And if we have a look at euro dollar, first of all, ahead of tomorrow's central bank meeting, we can see here that we dropped all the way down to 106.87, but have managed in the course of this week to hold above that low so far. But we still trade within its downtrend channel, and we are still below the 200-day simple moving average at 108.29. And whilst this is the case, further downside may actually be seen, and we'll have to see whether we have another interest rate hike, which looks to me more likely now tomorrow from the European Central Bank, and whether that will help the euro to bounce further or not. If not, and if we are to fall through last week's low at 106.87, the next downside target would be the May low at 106.36. So short term, it does look as if the euro dollar seems to be holding here ahead of tomorrow's ECB meeting, for the time being at least. Moving on to the British pound, you can see a similar story versus the US dollar here, in that we dropped down to 124.42 last week. And did retest that level earlier this morning, and held so far above the red line here, the 200-day simple moving average at 124.32, despite that much weaker reading with regards to UK, I should say, GDP data, which was out earlier this morning, and which showed us that GDP declined in the United Kingdom by 0.5%. So here we basically still have a very clear downtrend in place, lower lows and lower highs to be seen. And for the bulls to be back in control, even short term, what we need to see is a rise above Monday's high at 125.48. Only then could we see some sort of reversal taking shape at the moment here with regards to cable. Moving on to Japan, if you look at dollar yen, we can see here that dollar yen is resuming its uptrend. Last week, actually I would say this Monday morning, the currency pair dropped briefly to 145.90, but since then has risen again, as Japan producer prices rose the least in 29 months earlier this morning by 3.2% year on year in August. And that was lower than the downwardly revised 3.4% gain in July. We also had Japanese business mood out, and that improved in the third quarter of this year and jumped to 5.4% versus minus 0.4% reading in the second quarter, all of which has helped hasn't really helped, I should say, the exchange rate, with the US dollar still strengthening versus Japanese yen. And we can see here that we are still once again heading up again towards last week's highs at 147.87, and a rise above there would put the psychological 150 mark back into play. Moving on to the Australian dollar versus the US dollar, what we can see here is also some short-term consolidation, but here that has also happened since mid-August. We can see here that we dipped down to 63.65 back then. We tested that level last week at 63.58 and held there, and have since bounced back, but we are struggling with the July to September downtrend line, which currently caps the currency pair at today's high at 64.33. And for further upside to be possible from a technical perspective, what we need to do is take out Monday's high, exceed that at 64.49, in which case we could be heading back up again towards the 65 area with regards to this currency pair. But obviously much will depend on today's US CPI reading. And the same story is actually happening here with regards to dollar Canada. And as we can see here, what is interesting, though, from a technical perspective, is that we are actually, for the first time in several weeks, falling, and have done so for 3 consecutive days, and are now trading below the July to September uptrend line. And furthermore, the latest price high we saw at 136.94, if I zoom out here, coincides more or less with the April and May high. So we have previous resistance areas, which once again acted as resistance. And added to that, you can see that this latest price high here was above the high seen at the end of August. And if you have higher prices on the daily chart here, but lower highs on the relative strength index on the oscillator down here, that is called negative divergence. And we saw negative divergence here with this higher high not being confirmed by the lower high on the relative strength index, and that has led to this decline we've seen so far. And because of that, I wouldn't be surprised if we see further downside in the days and weeks ahead on dollar CAD. But for this view to become valid, what we need to see is a fall through the last reaction low. That is to say a low which is lower than the one to its left and to the right on the candlestick on the daily chart here. And that was made on the 1st of September at 134.89. If we fall through there and the red line here, the 200-day simply moving average at 134.66, then a top is technically in place, in which case we could then head quite a way lower towards 133 or so. But right now, this hasn't happened yet. We need to take out these levels for a top to be formed. Unless that happens, all we're seeing is a consolidation in a market which is now trading short-term sideways and no longer in a medium-term uptrend. The oil price has risen quite sharply over the last few weeks, and we can see that WTI, for example, has risen by about 15% from its late August lows. As you can see here, we've risen quite substantially from the lows seen back in June, all of this year so far. And the latest price rise has to do with the fact that basically OPEC predicts tight supplies and US oil stocks also fell, both of which propelling the oil price higher towards the psychological $90 mark for WTI. And this is a 10-month high for the price of oil. Now, why 90? It's simply a psychological, technical level, a round number. Quite often markets are attracted by round numbers and tend to gravitate towards these. From a technical perspective, also what we're seeing is higher highs and higher lows. And provided we stay above this August to September uptrend line, which currently can be seen around 87.50, further upside is really in store. And only if we were to fall through the 5th of September low at $84.63, would I question the current uptrend here. But that a drop to there looks extremely unlikely at the moment. Moving on to the price of gold, the gold price has fallen on this stronger US dollar over the last few weeks. It has come off its early September high at $1,953 per troy ounce, and so far dipped down to $1,908. And if that were to give way, we would then be heading down again towards the 25th of August low at $1,904, which incidentally ties in with the 6th of July low that was also made close there to that level of $1,903. So basically, we're talking about a psychological level of 1,900 being reached over the next few days, provided we stay below Monday's high at $1,931 per troy ounce. And last but not least, I'd like to mention orange juice futures, because orange juice futures yesterday, on Monday, actually made a new all-time record high and did so at $332.84 on this daily financial bet. And what is interesting is that we marginally rose above the high seen back in August and also the late August high here. So we have a triple top resistance here at the moment in place. We may actually short-term come off that and perhaps retest the August to September uptrend line around the $316 mark. But for the orange juice futures price, which basically orange juice futures have risen to these all-time highs on orange juice production in the US being at its lowest levels in a century or so, and as orange juice stockpiles in top exporter Brazil shrink to a record low, these high prices are likely to be maintained, and basically that will be the case and remain the case as long as we stay above the late August and September lows between $309.28 and $305.95. So what I'm saying is, from a technical perspective, provided we stay above $305.95, further upside does look likely for the price of orange juice, even if short term we may retrace, simply because we've tested this very important resistance area and so far haven't managed to break through it. If we were to break through it at some stage, we could be heading all the way back up, well, not back because it's an all-time high, but we could be heading towards the $340 and perhaps even the $350 mark. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on X, formerly known as Twitter. My handle is @AxelR_IG.